thank you for the invitation. I'm going to be very nasty today because we talk Robo-Advisors, which they just started, but I want to discuss how they will evolve into the future. So we jumpstart a few years of fintech innovation. And I come from risk management. I was head of risk in banks for 12 years, so I need an equation every time I make a presentation. And this is the equation today because we need to link financial innovation with technology innovation. I do still believe that in the fintech world, there's much more tech than finance, especially in the wealth management framework, because in wealth management, we need to decide what money is for, because we buy financial assets, and we need to decide how we're buying these financial assets, and that requires a different type of financial innovation. So the Robo-Advisors are just the beginning of the game for a certain reason, is tech innovation. The goal-based investing, whose IBM solutions are well representing with top fintech and financial institutions, is there to create financial innovation. And the gamification is an opportunity, more art than science, that I'm discussing with some institutions around the world to make sure that the innovation in finance and innovation in technology can become effectively disruptive and change the way we make investments. The reason we have this equation is because the attempt of Robo-Advisors, if their real ambitions, is to personalize personal finance. Now, a Robo-Advisors is not really personalized, it's fairly pigeonholed. But there are ways now that the technology that fintech demonstrated can be used in order to achieve an effective personalization of personal finance. So that goes here. Just a little bit about myself. You see, I was a happy kid. I became a risk manager. I created a fintech in 2008. There was a joint venture between a bank and a technology company, Quintessential, to create, through API, innovation in terms of the way we invest our money to help banks improve the way they talk to the customers. It didn't work out in the sense that I was not a unicorn. I wanted to get rich. I didn't get all of that money. But I was bought by IBM in 2012, and that was an amazing experience because I had the chance of traveling extensively to talk to a lot of financial institutions in terms of the wealth management transformation. So I put myself effectively in between the large companies and the fintech to discuss the transformation. Now, a few words about this slide. We are not going to bother you. This is basically the financial world. We have on one side innovation in information technology. So there is cognitive, Watson, machine learning, artificial intelligence, big data analytics, cloud. We know that these are forces which are changing the way banks and wealth managers are operating. They are there. On the other side, we have the individuals. So we heard a lot about how millennials engage with money, with investments. We know that millennials are different than me. They can go jogging and don't get tired. I can't. We know that the global financial crisis, especially in the mature economies, was severe, so that the trust of the financial institutions was strongly diminished, which changed the behavior of individuals in terms of accepting the idea of buying financial services from Alibaba or Facebook instead of going to BBVA or Deutsche Bank. And at the same time, we have the financial institutions, which is the last circle, which are transforming more and more. We know that the algorithmic trading is growing. That means less traders, less portfolio managers, more quantitative rules and programming to generate portfolios and money. A Robo-Advisors, in essence, is algo trading, is not really that, okay? It's a very, very primitive type of usage of algorithms. Indexing means using ETF, passive investment, instead of active investment. But basically, this is wrapped up into regulation, right? So the financial regulation that is forcing to raise the fiduciary standards or the transparency. Now, I like to think that the wealth managers are sitting at the epicenter, the digital epicenter of a tectonic fault, which is basically exposed to these forces. And for one reason or the other, one of these forces is pulling stronger than the others, which is creating financial innovation and fintech innovation. Now, my question to you, and I would like people to raise their hand, who believes that today fintech transformation in wealth management is a consequence of innovation and innovative ideas in the space of technology? Raise the hand. 4, 5, 6, 7. Who believes that The fintech innovation in wealth management, so Robo-Advisors, is driven by a change in the behavior of individuals. Raise the hand. 1, 2, 3, 4, 5, 6. So who believes that the success of Robo-Advisors or the fintech in the wealth management space is driven by regulation? Raise the hand. 1, 2, 3. Okay, I have only 3 friends. Because I do believe that financial regulation is the primary force that is allowing change to happen in the wealth management, because without regulation nothing really happens. Then of course investors' behavior, because if I don't have clients that can be onboarded and they change the way they relate to investments, I have no chance. And then it's technology that is exploiting a change in the financial regulation to address to the customer's behavior, which is modified, new solutions they can basically accept. And these are the Robo-Advisors. Now, why do I say that? We take it from outside the wealth management framework. First of all is banking regulation. We had the financial crisis. I left the bank in 2007. I thought the banks were defying gravities, looking at their balance sheet. And the financial crisis was very tough. So across the world, banking regulators raised the cost of capital, right? So that means that investment banking started shrinking. You see banks like Credit Suisse are moving out almost completely from investment banking. And also commercial banking went into a moment of difficulty because it was difficult to provide the loans to individuals, SMEs, or other companies because the capital was too expensive. That's why peer-to-peer lending had the first chance of being successful, because all of a sudden a market was opened that they could service by means of technology. At the same time, a market regulation, which is not banking regulation, knocked in order to provide further protection to the investors that were fairly hit by the subprime crisis and all of the reverberated consequences in the financial markets, which basically is providing 2 things. First of all, higher transparency. I need to tell to the customers that if I buy a fund from my bank, which is basically linked to the S&P 500 and costs 200 basis points, and if I buy an ETF, which is basically linked to the S&P 500 and costs 30 basis points, the asset and the risk is the same, but the cost is 4 or 5-fold. So the moment you create that transparency, of course the industry will have a problem, because the asymmetry of information that allowed the financial institutions to ask clients to pay way more compared to identical alternatives or similar alternatives is gone. And that is setting in motion a transformation of what individuals will be proposed in terms of product recommendation or portfolio recommendation. And the second is the ban of inducement, which is happening across the board. Regulations are different. In Korea it's not like in the US, right? In Europe it's not like in Australia. But more or less the trend is toward higher transparency and more independence. What is the ban of inducement? It means that if I am a bank and Joel is a client and wants to come to me and say, Paolo, can you sell me a fund? And I tell him, take the fund from David, it's a great fund. Now he's going to pay David 200 basis points because these are the fees of the fund. But then David gives back to me 120 basis points, which is a sales load, an inducement, because I gave it to Joel instead of something else. Now the regulators are now saying more and more vocally that this is not possible anymore, because what I give to him needs to be neutral and independent. If that happens, it means that my margin as a bank does not come from selling that product, but comes from selling advice, which Robo-Advisors doesn't really do, but started basically mimicking. And so there is a fundamental way on how people get and share the money inside financial institutions, and that's what the Robo-Advisors started capturing by means of digitalization, so they could find solutions to propose investment opportunities to the individuals that could optimize the fact that the ban of inducement and the higher transparencies were starting to become mainstream in the financial market community. So that means 2 things. Robo-technology, which I like to call technology more than advisors, because I don't really care if Betterment will be more successful than somebody else in this area. I care about the technology underneath and the processes, and goal-based investing, which is what we're going to discuss today a little bit, because it is essential in the transformational journey of what the money is for in the wealth management business. Now, what happens worldwide more in places like the US or the UK where regulation knocked in earlier and less in other places like in China where still the concept is not much there, is that banks are turning from distribution channel of products, sales-driven, is a packaging mechanism, okay? This industry is just a packaging mechanism. They wrap up the Easter egg nicely so that you buy it continuously. But they turn from a distribution of products into a distribution of advice, which is fee only. That's not easy. So the Robo-Advisor, you pay the fee per asset under management. The bank, you pay a cost for transaction, or you have other costs like inducements that you don't see because you bought or sold something. It's a fundamental difference in the way you make the money. Banks know that they are transforming themselves towards a fee-only business in the coming years. In Europe or in the US, the tipping point might be between 3 to 5 years from now. In Asia, might be slightly different, but we can discuss cases where this is happening as well. Now, the incentives for banks to change and to become robo-advisors or robo-like are affected by the regulation. The culture that enables you to transform from a distribution of products into distribution advice is provided by goal-based investing and gamification. Now, robo-advice for me is disruptive innovation. We've been using these terms a lot. Let's abstract a little bit from the theory or the buzzwords in the social media, but it is disruptive innovation in the sense that is helping making the transformation of the industry towards a commoditized industry where the margins are thinner and thinner, okay? So the cost, the race to zero prices, there is disruption in industry. But the cognitive gamification of the goal-based investing is sustaining innovation because no one in an industry, not even a robo-advisor, and I don't believe if you tell me that, is willing to create a company that has zero returns, right? Zero margin. So you don't want to build a business that has zero margin. You want to build a business that enables you to tire up your offer so that you make more money because you provide more added value to the customers. So you need to find the way out of the current robo-advisory trend through sustaining innovation, and that is what IBM is focusing on today.
We have about 5 minutes to wrap up, please.
Yes. So this is basically what is happening today. So just to simplify it at the end, we were in a world before the financial crisis where banks were run with high cost, but that was also matched by high revenues. We know that a lot of money had been spent and poured into the fintech world, but you know as well that that is just a fraction of all of the hundreds of billions that banks are paying in technology every day. Now, through the financial crisis, we are in a transition phase today. This is changing because banks are still running on high cost, but the margins are getting lower and lower, right? And the robo-advisors are really making competition by shrinking that margin, those margins further. That's why banks are in trouble because they cannot afford to have lower margin because the costs are high and are even soaring because the cost of compliance. So the new world we are trying to get into through digitalization is a world where the cost will be lower. So the robo-advisors, the fintech are showcasing business cases where you can do the business for lower cost, potentially scalable, but the revenues can become higher again so that you rebalance the cost income to make sure that the industry can basically thrive, create jobs, and possibly through regulation do something good for the respective customers. Thank you.
Questions from floor? Of course. Can we get the mic, please?
I can follow up to the two steps that you applied the financial technology to better robo-advisor. But can you give me specific example about the gamification? What do you mean by that, and how it added value to the financial sector?
Yeah, the gamification is something that is more art than science, right? Like robo-advisors are there, goal-based investing exists, yeah. But gamification is there because the way the most successful robo-advisors or the way banks are thinking of changing to turn digital wealth managers is to propose investment solutions around your individual goals instead of looking at the market. But making a proposal around your individual goal means that you need to change your perspective as an investor because the financial advisors have been taught for 70 years to sell the rationality of the market to you. Buy this fund, you will become rich. And you as an individual have been taught for 70 years to buy this irrationality from your wealth manager. I buy this bond or this fund so that I will become rich. Now, as this is not possible anymore, it was not possible before, and you need to be capable of buying advice around your goals, you need to be able to understand this change of behavior. So you need to start investing your money in a different way. How do you explain to individuals how they change their investment behavior, how they stay course when they see the volatility in the market? You know, the robo-advisors are trying to say, invest for the long term, so when the market goes up and down, don't disinvest, you know, stay course because it will be better. So you can explain to people, but explanations are not enough. So the idea is that you can create an experience, okay, because people learn by experience. So a game is an experience, because with a game you're willing to lose and you're willing to gain, and then you keep on playing again. Now, the pilots that fly Lufthansa, they do dry runs in a simulator, right? It's like a gamification because they simulate what would happen during a flight. So the idea here is that you can provide gamification not just to onboard customers like some banks did recently, but to help individuals rewire their brains to change, to innovate the way they access finance. Because innovating technology only, if you don't change the behavior of people, doesn't make sense. You just make it even faster to make the same mistake. And at the same time, some banks are now thinking, if I can use a game to understand how an individual behaves when he approaches investing, I can use it for profiling, because we know that robo-advisors are too simple. They make 3 questions and they pretend to tell you the truth. Banks make 10 questions and they pretend to tell you the truth. That's not enough. For a compliance perspective, you could create a game. You have web analytics now where you can control everything that happens in that game so that you can learn what the behavior of the individual would be effectively when you propose a financial crisis into the game and so on and so forth. And that can turn into better advice for something that you can use, you know, big data analytics and so on and so forth to analyze under the hook to understand your client base. So some financial institutions are thinking of that. Of course,
So
that means, and I
likely
give it to you, it takes more than 3 seconds to do a game to learn from a client than 3 questions on the web. And I know that that is not nice for robo-advisors, but at the very end, we're talking about money, investments, pensions, so we better spend more time than less time in taking care about our investments.
All right, time limited. We're going to move on to next. And if you have further thoughts, we can have a private channel conversation. Thank you very much. Oh, let's give them a big hand.